Hello from Automotive Markets. This is Ahura with the NFP report review and market reaction. The NFP report of December 2024, which is published a few minutes ago, showed another upside surprise with 256,000 newly created jobs in December 2024. That was very surprising, with unemployment level falling to 4.1 from 4.2 previously, which was market also expected to be repeated. But we can see even on the private sector, we can see 223,000 newly created jobs. That means the labor market is very strong and very reliable. You can rely on this market, and you can expect to see that, okay, this market is getting more job, getting more opportunities, which means that more income, and that income can increase actually and can hold the inflation higher, because with the higher demand, the price is not going to fall lower. However, we can see that the average income increased by 2.9% annually, which is a little slightly lower than 4% expected. But it's normal when you see that too many jobs are created. So there are different kind of the jobs with the lower income and higher income. So this is very normal to see that average is to slow down slightly. It's not just the only NFP report. The initial jobless claims that which published earlier this week shows that we had only 201,000 application for getting the unemployment benefit in the week, at the first week of 2025. That means that the market is very strong. The labor market is very strong, and we can say that this labor market can be as economic mover, the main mover of the economy in the United States. And when you see that the labor market is good, which means that the factories are working, the companies, the services are working, so they need the more labor to hire, they need the more job to create. So that means that generally the economy is improving, and it's in the positive progress. Initial job, it's not just initial jobless claim, it's not just the NFP. We go further. If you look at the GLTs, which published on Tuesday, also you can see that the GLTs, which fell earlier this month, previous month, to less than 8 million, to lower than 8 million, towards 7,500,000 some, and increased again to more than 8 million. So it means that more than 8 million job opportunities we had at the end of November. So again, all these numbers together means that the economy is moving, and the economy is moving positive, and the progress is good. So and if you add the other economic data, including the ISM, non-manufacturing PMIs, prices, and stuff like that, you can see all of these data, they are positive. Even the export, even the imports, exports, even the trade balance, all of them are positive, and all of them, they confirm that the U.S. economy is positive and progressing. We can see the reaction of these numbers and these data on on the bond markets. You can see that the U.S. 10-year Treasury note right now, that it's increased the yield and increased to 4.76%. That is very high. It's like multi-month high. So almost 0.1. It's almost 10 points higher than the earlier today. Generally, we can say that the labor market confirms, the strong labor market confirms the economy is high, economy is improving, and these positive and this strong economy can support the higher rates for longer. As we saw and we hear on the speeches that we had from the Fed speakers during the last days, they are not in a hurry to lower the interest rate as soon as they can, because they are right now mostly they're going to focus on the new administration on the White House. They're going to wait for new administration to start their job, to start their policies, to start their plans, and see the market, how the market going to react to these policies and these plans. So most probably we're going to have the first rate cause not before then the second quarter. And even if you want to have the rate cut in the second quarter, it's going to be at the second half of the second quarter, around maybe the May or June. So generally, that means the higher rates for longer. The higher rates for longer, it's normal. We say that if the higher rates for longer is going to continue, it means that we're going to have let me open the chart. We're going to have US dollar stronger, which is normal to see earlier. Just right after the news published, the US dollar increased almost around 109.80, and now it's trading around 109, around 40.50, which means that the US dollar is still strong and getting stronger, especially if we, as initial reaction of the initial reaction of the market to these data and to new administration, which is going to start its job not just around about 10 days later on January 20. All of them, they're going to support still the US dollar index, and we can see that the US dollar to continue on positive progress. So the US dollar still the fundamentally and the technically moves, it's still can remain bullish. With this reaction and the US dollar index, we can expect the first that, okay, to have to get some pressure on the gold, but getting the pressure on the gold, it means that why we can say that, okay, with the stronger US dollar, we can expect the pressure on the gold. But as you can see here, the gold is not a negative. The reason of that is the stock market. If you look at the stock market, you can see with these pressures on the policies, with the harder, or we can say with the more hawkish expected policies, we can expect more pressure on the stock markets. And when you have the stocks markets under pressure, means that these monies should go when we have a sell positions mostly in the stock market, which means that the money is getting out of the stock market and they're going to go somewhere less risky. Where is the less risky? The gold market, so US dollar market. So we're going to have the more demand for the gold. So even thought if the US dollar getting stronger, it doesn't mean that this condition, it doesn't mean that the gold can be get under pressure, and maybe they had some initial reaction, negative initial reaction to this data, but the gold generally could be a side movement and even the positive after these data and more pressure on the stock market, not just on the S&P 500. We can say same thing for the US 100, NASDAQ. We can say the same things for Dow Jones as well. Generally, these data means US economy and the labor market is strong, so higher rates for longer, more so which means that the yield is going to increase more, US dollar getting stronger, and more pressure on the stock markets. This is the conclusion of the data that we had and the market reaction and how we can what we can expect from these data. Hope it was useful for you and you enjoyed that. If you had any other question, don't forget to write down in the comment section. I will try to get back to you as soon as I can. Have a good time. Bye bye.